When do you say you got to trade the market you have? When do you say I'm being too dogmatic about my stance and my predictions as to what is going to happen? Guy, I'll start off with you.
Well, it's great to have Cameron and Danny here. We're sort of safety in numbers, I guess, tonight. But I've been on the bear camp in the broader market for quite some time, incorrectly since probably December of last year when this whole thing started. But, valuations were stretched then, or even more so now. And you think about where the world was December of 2021-ish. I mean, interest rates were still effectively zero. The Fed was just going to start to raise interest rates in March. 500 basis points later, here we are. And again, the market's going on its merry way. I'm hard-pressed to believe after what's going to be 525 basis points of hikes over the course of a year and a half, there's nothing to it. There's nothing to worry about. There are no ramifications. Nothing is broken, and the market goes on its merry way. It just doesn't make a lot of sense to me.
Danny?
People came into the year short technology, long energy and financials, somewhat defensive, as was I. And over a period of time, the chase began. When the tech stocks started to run, people forgot about energy and financials, obviously, until the March blow-up of some of the biggest banks in the country. I think about two big events that happened in the first half of the year. The first one, obviously, was Silicon Valley Bank and Silvergate and all the banks blowing up. What happened as a result of that 95% of people didn't see coming was the Fed, Treasury, basically guaranteed all deposits going forward, in my opinion. That's what they did, and they injected $500 billion into the market. The second thing that happened was the debt ceiling crisis that happened. What happened as a result of that? We have an unlimited debt ceiling now through January 2025. Those I did not have on my bingo card as a result of that. That being said, as we sit here today, S&P earnings have gone down in 2023 since we've started the year. And in 2024, they've gone down since we started the year. So I'm hard-pressed to, quote, chase the market here. That being said, I'm sure we'll talk about it later, there are names you can own and still be bearish on the overall market.
Right, and that's sort of the stance that you take, Cameron. You're finding some pockets where you do want to invest, but overall you're a little bit cautious.
Yeah, and what we've learned this year is that valuations don't matter when everybody's underweight or everybody's short and bearish already, which just means that people get drawn into the market kind of regardless of what valuations are. But now if we look at where positioning stands, we're at a point where you've seen huge inflows into tech. You're now about 75% of the way from going deeply underweight to very overweight. So you still have a little bit of room to run to get to that max overweight position. And once you get there, that's probably when valuations start to matter. And that's why if we're looking at positioning today, we're saying we'd rather buy names that are cheaper, that equal weight index, for example, trading at about in line with average versus growth trading well above average. So I think valuation discipline makes a lot of sense if you're looking out 2-3 years. But if you're only looking in the next couple of weeks, the best trends are in those growth names.
Yeah, I mean, no doubt about that. And I think, though, really the question is what's the pull forward, right? And so if we want to talk about valuations, like I'm looking at this is facts that they track, the forward 12-month PE of the S&P 500. It's trading near 19 times. That's above the 5-year average of 18.6, above the 10-year average of 17.4. And Danny just started this conversation by talking about S&P earnings expectations. They are still up, I think, expected to be up 2% year over year, but they're down from where they were massively a year ago or something like that. So I say to myself here, what are the names that are driving all this performance? We know that the 7 stocks make up 26% of the S&P 500. We know that they are a disproportionate amount of the expected earnings growth for that index that I just told you is trading at historically high levels. And then if you think of all the excitement in and around those names, they are pulling forward a lot of excitement around something that might or might not materialize in the not so distant future. So to your point, Cameron, these are great trends to invest in. This is what investing in technology is all about. And that is, I think, the history of all of our careers in the markets over the last, let's say, 25 or 30 years. But sometimes when it feels like a feeding frenzy, it's not exactly a great time to kind of jump in the pool, if you will.